Welcome back everyone to another episode of Providend Money Wisdom Podcast. I'm your host, Isaac, Associate Advisor at Providend. Joining with me today is a very special guest, Tan Chin Yu, Lead Advisory. Hi Chin Yu.
Hi Isaac.
So you just touched down yesterday from Australia. So how was your trip?
No worries. It was a good trip. Just touched down yesterday, so a little bit jet lag, but still very excited to be sharing all about CPF in this podcast.
Yeah, so I think prior to this podcast, you have done many interviews or podcasts with CPF Board, am I right?
Yeah, so I did one with CPF Board. I think we were talking about the rising inflation at a time, which is a concern that many people have during last year's market downturn and rising interest rates. So we'll see how it goes this year.
Yeah, so that's why we chose you to do this topic. So I hope you're not too bored, but you're definitely the most, or rather in terms of this subject matter, you're definitely an expert. So firstly, what is Providend's view on CPF? Why do we believe in it?
Yeah, so Providend, we have been advocating about CPF, and the reason is very simple. It's because CPF forms a very good foundation in anybody's retirement. So as we all know, if you are a working adult, working for a firm or a company, you have to contribute part of your income into CPF. Typically it's that 20%, and then you have another 17% coming from the employer. So in a way, it kind of forces you to save for the future.
Savings, right?
Yeah. It sort of, don't allow you to spend all your monies away because eventually you still need it. But at the same time, it gives you a good foundation, as in, your ordinary account, it gives you a certain floor rate of interest. Your special account, which is meant for retirement, it also gives you a pretty good rate for the future. So in a way, you even not doing anything, you don't lose out too much to inflation.
Right. So very briefly, just now you mentioned, what's the purpose of the 4 different accounts? So ordinary account, special account, medical account, and of course retirement account.
Yeah, so CPF, there is 4 accounts like you mentioned. So the first one, which many people would know, it's ordinary account or CPF OA. So CPF OA, you contribute a certain portion every month, and then the interest that you're getting has a floor rate of 2.5%. So OA is a bit more flexible in the sense that CPF still allows you to use it for certain occasions. So one common example is people like to use OA to pay for housing. So especially for younger adults, where you're starting a family, you just started working, you have built up a bit of this OA, they might want to use this money to buy their first home. So that's one common use of OA. Whereas the special account is really more specifically meant for future retirement. So special account earns a little bit more. It earns a 4% interest floor rate at the moment. However, special account, you can't really use it for many other purposes apart from your retirement.
Right, so there's many more use for OA but of course, as we get closer to retirement, the special account will be more and more relevant. Is that correct? Yeah.
Yes. Yeah, then of course you got your MediSave as well. So MediSave also earns a good 4% interest. And MediSave is really meant to pay for medical bills. So it's a bit more flexible than special account in the sense that, if you go to the hospital, you can use it to pay for your MediShield premiums. You can pay for certain other insurances or other, even dental, you can use it.
Right. So what about the retirement account? Like how, when do we get it? I myself, I don't have a retirement account now.
Yeah. So same for me. I only have these 3 accounts, OA, SA and MA. Retirement account is only when you turn 55. That's when CPF will create this new account called retirement account or RA. So at that point in time, what will happen is that part of your CPF in your OA and SA will be transferred over to your retirement account, and this forms this pool of money that's meant for your retirement. And eventually, in today's scheme, it's going to be converted into CPF Life that's going to pay you a monthly ongoing income.
Right, so the account will be formed at 55, and then you will still continue earning interest until 65 onwards. From 65 to 70, you have the option of when you want to kickstart your CPF Life. Is that correct?
Yes, that's right.
Yeah, so that's the purpose of the RA account, right? Okay, so in terms of, let's say I'm someone who wants to grow my CPF money. Is it something that I can do? Like, you mentioned that I can invest, I can use my OA to buy a house, but let's say I want to grow it. Can I invest my CPF monies, and for how long should I invest it for?
So, assuming that, if you don't want to use your OA to pay for housing and you really want to set this money aside for your own retirement, there are a few options. So, one option is that you could transfer your OA to SA and let it compound at a higher interest rate compared to, your 2.5% that you are getting. The other few options is, like you said, you can invest it, but investing comes with volatility. So one thing that we often talk about when it comes to investment is that you want to have enough time horizon.
Right.
So typically, if you invest, you want to make better than the 2.5%.
Yeah, definitely. Yeah.
Yeah. And typically people look at, equities, and we talk about equities. It is ideally in a diversified portfolio, but even equities in a year-to-year short-term basis do see volatility. In fact, recent years haven't been easy, in the markets. 2020 COVID pandemic, markets fell by 20%, sometime around March. And 2022, of course, we saw the bear market with concerns of inflation, concerns of, wars happening. So you do want to have enough time horizon to weather these ups and downs. And typically, I would suggest, you want to make sure you have at least 10 to 15 years.
Let's say I'm 40 years old and I'm going to retire at 55, and I want to invest my OA money. What options do I have? Is it the same as let's say, I have some cash investments. Can I use my CPF OA to buy the same instruments that my cash investments are in?
So CPF, the instruments that are available are more restricted because they have to be approved by CPF. However, today, I think the range of instruments have, widened a lot more. So, what I mentioned about having a diversified portfolio, they do have that as well. I wouldn't say, too far off on what cash can do, but the same principles applies. You want to make sure, again, enough time horizon, you can weather the ups and downs of the markets.
Right. So the strategy should still be the same, even though the instrument could be slightly different because of CPF restrictions, but we try to aim for the same global diversification and also to ensure that we have the right time horizon.
Yep.
But now you mentioned, you mentioned that CPF OA is giving 2.5%. As we are all now aware, T-bill rates are now exceeding CPF OA rates. T-bills are guaranteed by the government and essentially is it's safe, right? As compared to, let's say, investing in the equity markets. So is it wise to start investing our monies, our CPF monies into T-bills?
Yeah, not a bad idea. I mean, today we are in a bit of an unusual situation where suddenly your interest rates are, going sky high. And if you look into things like your T-bills, your fixed deposits, actually the risk is very low. You could consider putting some of your CPF OA monies to earn a higher interest. Just that you do have to take note that you do give up certain interest in the months where you invest. So what I mean by that is during the month where your money goes in, from your CPF to your T-bills, for example, you don't actually earn an interest for that month. And then the month where the money gets credited back into your CPF, you also lose interest for that month. So you need to take into consideration that you're losing, 2 months by doing this.
Right. So that's something that's often overlooked by people. I mean, after their T-bill matures, they're like, when they do their calculation, they're like, oh, I get roughly the same as, if I just left it in the OA lah.
So you want to consider when you're putting your CPF into these instruments, the rate that you want to get should be at least 3.5% instead of just looking at beating that 2.5%.
Yeah. Okay, so we always talk about investing, or we have been talking about investing our OA monies. Like, why do we typically not recommend that our clients invest their SA monies?
Well, that's because SA gives a very good floor rate of 4% already, and that is very hard to beat consistently. So of course today, we talk about T-bills, but even T-bills are only at 4%, which is, about the same as the SA. But the second reason is the available instruments that you can invest your SA is also very limited. So early on, you talk about, can we invest CPF in the same things as we can use cash for? SA is even more restricted. And why that is so, again, because SA is really for one's retirement, and CPF, want to make sure that the investments shouldn't be too high risk. So if you consider that, if you put your monies into very low risk instruments, they also typically tend to be lower returns, and then it doesn't really make sense to invest your SA.
Right. So 4%, getting 4%, compounded and like is essentially a linear growth when you leave it in the SA compared to equity. Let's say, historically, yes, you can get maybe like 6 to 8% or even 10%, but the volatility have to be taken into account. To ask the tougher question, let's say, Jin, you have a client today that comes and asks you like, Chin Yu, I'm very okay with volatility. I have 20 years time horizon. Can I invest should I invest my CPF SA?
It's still hard because again, you're restricted by the instruments.
Right.
Yeah.
So even if you have the time horizon or you have the willingness to take the risk, but the instrument might not be suitable to help you beat this 4% hurdle rate.
Correct. So you can't really invest in the same things that you can use your OA for.
Right. Okay, so on to very interesting part about CPF. Actually, for CPF, there are certain tips and tricks that you can do. A well-known tip and trick is actually to do SA or OA shielding. So in what situation should I shield my SA and in what situation should I shield my OA?
Okay, so maybe I just give a background on what shielding is.
Yeah.
So what happens is at age 55, CPF will take monies from your OA and SA to transfer into this new retirement account that I mentioned earlier.
Yeah.
And this is meant for your CPF Life. So whatever that's transferred, the remaining will remain in your OA and SA, and these will continue to earn your 2.5% and 4%, and it can be withdrawn anytime.
Right.
So shielding is a way that to allow somebody to keep as much as possible in their OA and SA, because essentially after that it becomes more like a bank account that earns at 2.5% and 4%, which is pretty attractive.
Right.
And to prevent this automatic transfer, what people do is that before they turn 55, typically we suggest roughly about 1 month prior, they would sort of quote unquote invest their monies into a very safe instrument. So sort of parking this aside so that when they turn 55, when CPF tries to withdraw those monies from those two accounts, it's not there.
Right. So if when you turn 55, the CPF will look at your accounts and be like, oh, okay, this is the amount of SAs that I can use for your RA, and then they'll take from your OA and vice versa for OA shielding.
Yeah. So for SA, which is more common, a lot of people, they want to do that, is because by default, CPF will take monies from your SA first. Yeah. And of course, SA earns more than OA. So a lot of people, they rather have CPF drain the monies from their OA to transfer to a retirement account to form their CPF Life. So what they do is that they shield this special account, and then it sort of forces CPF to take monies out of the OA more to fulfill this full retirement sum that needs to be transferred over.
So after your birthday, then you just sell it off and it would go into your SA account?
Yeah. So after your birthday, when you sell it off, you'll go back to your respective accounts, and then it's there. You can use it at 4%, take out any time like a bank account.
Right. So you have higher interest if you do that.
Yep. So for some, they do want to consider shielding OA. That's probably less common than the SA because OA gives 2.5%. But for those people, they feel that it's attractive for sort of this bank account that gives 2.5%. They want to shield their OA. So in return, instead of using their OA to form this full retirement sum, in their CPF Life, they rather use cash to top up. Yeah, because in a way, especially in the past where cash is actually yielding a lot lower, they rather have CPF there that earns 2.5%. Then you use the cash to make up the difference.
Yeah, that was the time when cash was yielding like 1 or even less than 1%. But now we can't really say abnormal time, but it is something that we have not experienced in a long time, where cash is actually giving like 3+%. Yeah,
but of course this might be temporary. So again, you do want to consider in the future, what if interest rates go down? You don't want to, do something for the short term, but after that, it doesn't really make sense.
Right. Okay, so on to the next trick. So, it's like some magician. Should I max out my MA, my medical account? And why would anyone do that?
Well, maxing out MediSave is not a bad idea. Number one, MediSave gives you 4%. So it sort of allows you to build at the same, rate as your special account. The second one is it can be very flexible. So like I mentioned, even certain dental procedures, you can actually use your MediSave. You can use it to pay your premiums. You can use it to pay certain other, medical needs. But the other point is that once you maxed out your MediSave, so maxing out means that you hit this basic healthcare sum, which is the BHS.
Right.
So once you hit that, any new contributions from your earned income actually flows onto your special account. So in a way, because you have maxed out your MediSave, you can actually build up your special account faster through your earned income.
Right. So this year's BHS is 68,000?
Yes, I think so.
About, right? Yeah. So if let's say I max out to 68,000, then at the end of the year, the interest, you can't go into the MA, you go into the SA. At the same time, SA is also having that 4%. So that's how you can grow your SA faster, right?
Correct. That's right.
Yeah. Okay, so on to tax benefits. I heard that CPF, you can get some tax benefit by topping up. Like, how do I enjoy these benefits, and in what situation is it worth considering doing so?
So you can get tax benefit by utilizing, this retirement sum top up, or some people call it RSTU. And this allows you to reduce your taxable income by 8,000 if you top up to your own account. Yeah, own account meaning your own special account. If you are beyond the age 55, then it'll be your retirement account. And then it also allows you an additional 8,000 in tax savings if you top up your loved one's accounts.
So 8,000 in tax saving, you mean in terms of accessible income?
Yep.
Does it matter when I do the top-ups? Like, if I top up at the start of the year, or, if I top up at the end of the year, does it matter?
Well, topping up at the start of the year gives you more interest because actually there's a calculation that starts accruing if you top up earlier. Yeah, but if you ask me, in the grand scheme of things, it might not matter that much.
Yeah, in the long run, But for those who, who have the option to, just remember that you're topping up at the start of the year will allow you to enjoy interest for the whole year before it's credited.
Yeah, I mean, the other thing is that I always tell clients, you don't want to rush at the year end, be it your CPF top up or SRS. You want to do it early because the last thing you want is, you finish the end of the year and realize that you forgot to, get your tax savings for that year.
Yeah, like miss the window.
Yeah, exactly.
Go back. Yeah. Okay, so CPF Life. So just now you mentioned earlier in this episode, like that at 65 we get the option to, from 65 to 70 we have the option to opt into CPF Life. It's when I read more about CPF Life, it's still a bit, there's a certain complexity to it. There are so many different options. So for example, there's different kind of plans like basic, standard, escalating. Then even then, there's different kind of sum of money like basic retirement sum, full retirement sum, and enhanced retirement sum. Could you briefly explain the difference, for example, between the BRS, FRS, and ERS?
Yeah, I mean, there's so many schemes that you're right that people do get a bit confused.
Yeah.
But basically, these three things that you mentioned, the BRS, basic retirement sum, FRS, full retirement sum, and the ERS, which is the enhanced retirement sum, they are basically just different sums that you set aside for your retirement account. And just simplistically saying, the higher the amount that you set aside, the higher your monthly payouts. Okay, so the default is the full retirement sum or FRS that you need to set aside from age 55. And that is, I think, about close to 300,000 this year, which is the full retirement sum. And this will give you, I think, around, if you're age 55, around 1,500, 1,600 every month in terms of payout starting from age 65. Yeah. BRS is in the event where you decide, okay, I don't want to set aside so much for my retirement account. If you charge your property, which means that you already got a fully paid property, and then you have opted to set aside a lower amount, CPF actually allows you to set aside only half your full retirement sum. Yeah, and of course, as a result, your monthly payouts also is lesser. So you do need to make sure that you do have other streams of income, to cater for your own retirement. Yeah. Then lastly, for enhanced retirement sum, if you wish for the highest payout, you can choose to top up all the way to the ERS, which is about 1.5 times of the full retirement sum.
Right. So if, from my understanding, if a person's financial situation allows, why do we usually recommend to those people to top up to their enhanced retirement sum?
Well, I guess, that brings back to, again, CPF really provides a very strong and good foundation in anybody's retirement. Not only good, gives a very good basic income for life that mitigates longevity risk. It also gives a very stable income because you don't have to worry too much about market volatility. You get a very consistent stream of monthly income. So, we do recommend to take advantage of the scheme as much as possible to top up, to the ERS. And even at, enhanced retirement sum, it is really not very high. I think at a 55-year-old, you probably get about 2,000 plus a month. And I would say, a lot of people might need more than that. So you still got to supplement it with other streams of income. But, again, at least CPF gives you that foundation.
Right. So yeah, so topping up to ERS, is guaranteed by the government. It's quite hard. I mean, obviously there could be higher yielding instruments out there, but in terms of safety and of course there's can I say no volatility when it comes to, in a way it's like more linear in terms of the growth of your money.
I would say very minimal volatility. Of course, CPF scheme, it's a bit of a risk pooling scheme where, there's still some variations, but you wouldn't expect it to be as, large as the financial markets.
Right. So it's quite hard to beat that.
Yeah.
Okay, so lastly, what do we, when considering between basic, standard, and escalating plan, what should people consider, when they're choosing between these three?
So the default plan is standard. So if you don't choose, they'll give you the standard plan. And standard prioritizes the CPF member. So basically, you think about CPF and what it's trying to do is to provide a good retirement for the CPF member. And standard gives the highest payout. Now, for those who have family, they want to consider leaving behind, more monies. So in that case, they might opt for the basic plan. So basic plan gives a slightly lower payout every month, but in the event where the CPF Life member, is not around anymore, it gives out a higher bequest. Yeah, so you leave more money behind for your loved ones. And lastly, for escalating plan, escalating starts out at a lower monthly amount. In fact, it's much lower, but it caters for inflation. So every year it goes up by 2%. But I would say, it's really for those people who likes the scheme to just cater for inflation for them, compared to, having a standard plan that gives a higher payout, but then they need to self-manage that inflation portion.
Right. Okay, so thanks for that, Chin Yu. So we have a bonus question, a question that I didn't really prepare you for. So what is your view on 1M65, the movement 1M65?
Well, I think it's a good movement. In the past, many people, I would say, not very familiar with CPF. In fact, a lot of people don't like CPF because, especially when they're younger, they keep putting money in and they say that, well, I don't know when this money is going to come out. So I thought that this movement is good, that it raises awareness to people that actually CPF, it's a very good tool to build up that foundation.
Yeah, so before we continue, could you briefly explain what 1M65 is?
Okay. So 1M65 basically means that you try to get to 1 million in your CPF by age 65, and this 1 million is it gives a good, decent foundation for your retirement. Yeah, and I think speaking of 1 million, it is a good goal to aim for in general today. I mean, most people with 1 million, they should be able to give a decent retirement. Of course, if you need more, you need to get a higher amount. And to get to this 1 million, CPF actually provides a very good way. Earlier we talked about 2.5%, 4%, if you transfer to special account, that 4% actually compounds pretty well for you to hit that number. And again, it's sort of an automatic scheme that every month, you're being forced to save. And you think about it, you're saving about 37% every month, and that's a really good number. Yeah, so After that, when you hit, your 55 years old, 65, it does convert, part of that gets converted into CPF Life. And then again, it gives you that monthly stream. You don't have to worry too much about, okay, how do I budget? How do I, split my monies between now and the future? CPF actually does a lot of that for you. Although I have to say, if you consider inflation, so today if you're a young person, then maybe 1M might not be enough for you. Yeah, so let's say, you have another 20 years towards a retirement, you might potentially need to achieve, for example, 2M65.
Yeah, so in a way, like this movement is actually good behaviorally. So it may not be the most efficient way, but it really if it gets people saving or rather thinking about long term and their retirement. So it's something that is very positive for society.
I think it's positive for a lot of people, especially those who might not be so familiar about investing.
Right. Okay, thank you so much, Chin Yu. So that's all for this week's episode. I hope you all enjoyed our discussion on CPF. So if you like this episode, please follow our podcast and follow us on social media for similar contents. As always, thank you for listening, and I'll see you in the next episode. All analysis, views or opinions from interviews, recommendations and other information broadcasted, podcasted or published herein are provided for general information purposes only. Information expressed does not take into account any specific situation, particular needs or objectives and should not be construed as specific advice or a recommendation. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal or tax professional before taking any action. Providend Limited does not accept any liability for any loss whatsoever arising from any use of the information broadcasted, podcasted or published herein. All contents and information contained herein may not be copied or reproduced in whole or in part by any means without prior written consent of Providend Limited.